There are some striking parallels between the current banking crisis and the savings and loan crisis in the 1980s. So in this video, I'll look at what went wrong then and compare it with what's going on right now. Then I'll tell you whether I think we've learnt any lessons from the past. Now, don't forget, if you do enjoy our videos, please do subscribe to our channel, and that way you won't miss any new content. So let's look at the banking crisis and compare it with the savings and loan crisis in a bit more detail. Firstly, what is a savings and loan association, or a thrift as it's also called? Well, there is no equivalent in the UK. The closest thing we've got is a building society. But these institutions originally were set up in the 1800s in order to provide mortgages for just normal people. In many cases, they're mutually owned by their customers. They're funded by deposits, so it's almost like a lending club where lots of people group together to save money, and then that money is lent out to people so that they can get mortgages. Now, these were very successful in the United States as a funding model for mortgages, such that by 1980, there were over 4,000 thrifts. And altogether, they had assets of over $600 billion, of which $480 billion was in mortgage loans. And that made up about half of all mortgage lending in the United States in 1980. Now let's turn to the parallels between the savings and loan crisis and the current crisis. The first one is a spike in inflation. This was caused by an energy crisis in the late 70s in the US, which then spread out into other goods and services prices. So you can see the headline rate of inflation in blue and the core inflation rate, which excludes energy and food. So during the late 70s and early 80s, this was quite prolonged and it came with a kind of double spike. Turning to the more recent episode in 2020, you can see that again there was a very rapid onset of headline inflation. Initially it was due to headline inflation increasing, but then it spread out to core goods and services. Now the policy response has been the same from the Federal Reserve, which is to aggressively increase short-term interest rates. So beside me here, you can see that happening between 1975 and 1990. The short-term interest rate is shown here in blue, light blue, and the 10-year rate is shown in white. And the difference between the two, the 10-year rate minus the 1-year rate, is shown in the bottom panel. And when the 1-year rate exceeds the 10-year rate, this goes red. And then you've got a yield curve inversion. Now that's problematic for banks, as we'll see in a moment. And it was also problematic for thrifts. Now let's look at the more recent episode, and again you can see the Fed's response has been to very aggressively increase short-term interest rates, such that those now exceed the 10-year rate at the long end of the curve. So yet again what we've got is a yield curve inversion. What we haven't seen yet is a recession, as happened in the past after these inversions. How does this cause problems for banks? Well, essentially the problem is that their liabilities pick up higher interest rates very quickly. Remember, the liabilities are how a thrift or a bank funds itself, and that cost of funding increases very rapidly. And that's because these deposits have to compete with, say, those short-term treasury rates. If you can buy a money market fund, or alternatively just buy a US treasury, which is yielding 5-6%, well, it's going to be not very attractive to keep your money with a thrift or with a bank deposit, which offers you much less. So one problem is deposit flight from both banks and thrifts when interest rates are increasing rapidly at the short end of the curve. At the same time, for thrifts in particular, the problem is that they've fixed their long-term rates for their customers who have mortgages at very low rates when rates were lower. As rates increase, remember those mortgage rates are locked in. So on the asset side, which generates the income for the thrift, they're not getting a very high income at all. Whereas on the liability side, they're having to pay higher rates on their deposits. Now, there were some pieces of legislation which allowed thrifts to keep their rates lower than other commercial deposits. But the fundamental problem, which is a mismatch between their assets and their liabilities, wasn't solved by this legislation. And if you want to see a movie which kind of explains this problem, then just take a look at It's a Wonderful Life. It actually refers back to a previous crisis in the 1930s, just after the Great Depression for the savings and loan associations. But here you can see Jimmy Stewart trying to stop people taking out their deposits. And he says, well, look, the money's not in the bank. I've just lent this money to the guy who lives next door to you. And if you take out your deposit, you'll essentially be foreclosing on his loan. So if deposit flight starts, it's a real problem for these thrifts. And another problem is if they've locked in low rates on their mortgages and they're having to pay more on their deposits, then effectively what they have is insolvency. The income on their asset is less than the cost of their funding. So effectively what you have here is a zombie thrift. Now there was something called Regulation Q, which created a ceiling rate on savings deposits, but this didn't fix the essential business problem, which is that the mortgages weren't generating enough income to pay the interest on the deposits. But you can also see why it was so much more attractive to buy those 3-month treasury bills than it was to have a deposit with one of these institutions, including commercial banks. There is a slight difference between the savings and loan crisis, which was to do with concentrated assets. Remember, the money of these savings and loans was mostly invested in mortgages, and then later on, as we'll see, when they were deregulated, there was a problem with risky assets. Whereas in the current crisis, the problem is concentrated liabilities. A lot of the depositors, for example, with Silicon Valley Bank, were in exactly the same sector. So when deposit flight happened, due to common circumstances, i.e. VC money drying up, or because of the crypto crash, then that deposit outflow was what caused the problems. And in the current crisis, the problem was the supposedly safe assets, which are US Treasuries. These have lost value as interest rates have increased. But what is similar between these two scenarios is the asset liability mismatch, the duration mismatch between short-term liabilities and long-term assets. Now, recently in my weekly market roundup, I actually talked about money market funds and how the fact that they're paying high rates of interest has been a problem. So here is that story, and I always try and keep things fairly compact. Usually there are 3 stories in the roundup, and I try and cut through the noise of what's going on in markets and focus on what matters to investors. So this is absolutely free. It comes into your inbox on a Friday evening. And if you want to learn more about that, just go to the link in the description beneath me. So after rates increased and some of these thrifts got into trouble, what happened next? Well, the political solution was deregulation. So here you can see Ronald Reagan signing something called the Gance and Germain Depository Institutions Act of 1982. Now, this was well-meaning. It was aimed to ease pressures on depository institutions, including banks, as the Fed raised interest rates to curb high inflation. However, whenever there's new legislation, particularly deregulation, it usually creates unforeseen consequences. And in this case, it did backfire. The reason was that these savings and loans companies were allowed to make more risky investments. Now, of course, if you're underwater because your deposits are having to pay out higher rates of interest, then you want assets which also pay a higher rate of interest. If you increase the return, usually you have to dial up the risk. And if you're not an experienced lender in these new markets, then you can run into trouble. So when savings and loan associations started to make loans in commercial real estate, those loans started to go bad. And that's because they poorly managed the risk of those loans. And in the following years, there were a lot of bank failures, but also many failures in thrifts. And if we look at the overall bill from that crisis, it came to about $160 billion. And guess who had to pay for it? You guessed it, it was the taxpayers. The taxpayers' share of that bill was about $132 billion. What's also fascinating is this breakdown that you can see beside me of the losses over time. Notice that there's an initial hump which peaks at a loss of about $100 billion. And that's the bottom shaded region here. Now that loss is due to the increase in interest rates during the early 80s. But notice what happens after that period of deregulation in the early 80s. There's a new set of losses which start to balloon, and these losses are accumulated due to asset quality problems. So these zombie S&Ls that were effectively insolvent try to double down on their risk by lending in the commercial real estate space, for example. Those loans went bad, and then the problem just got much worse and more expensive to solve, such that by 1992, the bill came to not much less than $200 billion. Now, have the lessons from the savings and loan crisis been applied to the modern day crisis? And unfortunately, I don't think they have. I think the first lesson is you shouldn't save the zombies. These are the insolvent institutions where their income is less than their costs. There's no point in saving those institutions. And when you do try to save them, perhaps by deregulation, then ultimately the problem gets worse. It's much better to let those institutions fail, perhaps do protect the depositors, as happened with Silicon Valley Bank, but the institutions themselves should be allowed to fail. Whereas what we've seen the Federal Reserve do is essentially laundering risk on its own balance sheet. And that's what the Bank Term Funding Program essentially lets banks do. They can present their not very valuable long-term treasuries to the Fed, which pretends they're worth par, and they can borrow against the full value of those assets. That probably is delaying the inevitable for many banks. And as we saw in the late 70s and early 80s, that could cause problems down the road. What we've also seen is the importance of matching assets and liabilities. There really isn't that much legislation which ensures that banks have to do that. So perhaps something that should come out of this crisis is enforcing better risk control and ensuring that if your assets do fall in value, there's some kind of hedge in place to mitigate those losses. That was one failing which was identified for Silicon Valley Bank, for example. And finally, I think something which people sometimes forget is that deregulation often causes secondary problems. It's not usually long before deregulation happens, particularly in the banking sector, and crises follow. So if you do see that happening, deregulation, then it's probably time to panic. Now, another thing that often goes hand in hand with these crises is fraud. And of course, there were some huge political scandals and prison sentences that came out of the S&L crisis in the 70s and 80s. Now, I'm not saying that's going to happen this time, but it usually does. Let's just hope that they don't go down the deregulation route, which usually causes secondary problems. Now, don't forget, if you do want to learn more about our weekly market roundup, it's completely free. You can find out more by clicking on the link in the description beneath me. And as always, thank you for listening.